Hi Phil, thanks for joining me today.
Hi Walt, it's a pleasure.
First question, given the fact that we've had a large number come out recently, inflation at 6.1, what are your thoughts?
Yeah, well, it's an interesting point, Walt. If you look at those figures, in Australia we calculate those figures on a quarterly basis, so it actually reflects the inflation that was apparent between March and also June. And of course, if you look at what's happened in inflation recently, there's a consideration that the US has actually achieved peak inflation and that a lot of commodity prices are coming down. For example, one of the big components of inflation is actually the price of oil. And if you look at oil, it peaked at around $120 US a barrel and is now down to around $100 US a barrel. Now, oil's such a big component. It's obviously a component for transport. It's also LPG, it's also diesel, it's also avgas, it's also cosmetics, it's lipstick, it's sunscreen, it's plastic. So oil is actually pretty pervasive in terms of what constitutes our commodity use, but also our cost of transportation. So it's a big component when we actually calculate inflation. If you look at it in terms of the building industry, also look at the price of iron ore and lumber. I mean, lumber is now half of what it was during the peak, during the period of the Ukraine war to now. So if you take the thought that we may have actually achieved peak inflation in the US, then it could bode quite well if those commodity prices come down or even stabilise. In fact, even if they stabilise, you'll actually have inflation at zero.
So they're trying to dampen inflation through rising interest rates. So what impact does that have, say, on Trilogy and our funds?
Yeah, sure. Well, look, first of all, let's look at why interest rates rises. And interest rates are rising currently as a result of the overheated economy. Now we've got unemployment down at such a low level, we've got high consumer demand. So you've got supply issues. I mean, a lot of supply in terms of our local soft commodities is due to the floods. The central banks around the world are trying to take the heat out of the economies by doing that. But of course, the issue is that they don't overstep the mark. And actually, the thought is that could actually cause a recession if, in fact, they have interest rates too high.
They've gone too far, yeah.
And if you look at most of the banks around Australia, they have similar views, but also slightly disparate. For example, if you look at the CBA, they're picking a peak rate in the official cash rate around 2.6% in November.
Yep.
But if you go to Westpac, they're saying, oh no, we think it will be 3.35. Everyone's agreed that there'll be increases in August and there'll be increases in September, typically of about 0.5% for each of those. And then it might be the case that the RBA takes its foot off the accelerator in terms of rates for a period of time, see how it goes. After that, of course, it's a question mark as to whether inflation is going to be tempered or whether it's going to be something that becomes more endemic. Because the fear, of course, with the RBA and the fear with central banks around the world is that inflation actually breeds upon itself. So if prices go up, therefore you want to pay a rise to match that. And of course it becomes a never-ending cycle, just like we had in the 1970s. Now in terms of where we are with Trilogy, look, when we look at our monthly income trust, and bear in mind that that's largely residential based, we have seen price increases during the course of the last 12 months, there's no doubt about it. But what's interesting is that when we talk to our quantity surveyors now, they're saying to us generally that we've seen the peak or the most increases during last financial year, and this year they still see increases, but not to the same degree.
So that'll be tempered quite a bit, Phil?
Well, that's what we expect. Now, I've got to say that when we look at our portfolio, where I think we've been impacted the most is not through necessary cost increases, but actually delays which have been caused by wet weather. So if you look at the flooding events and you look at the rain events in Queensland and New South Wales, that's had some impact. And on some projects, that's meant that we've had to extend those projects. Yeah. But I've got to say that overall, that impact hasn't been significant. So you know, we look in terms of the future that with those costs being more tempered, that it bodes well for the portfolio.
There's a lot of commentary at the moment in relation to the construction industry.
Yep.
And the health of the construction industry, given we're in a rising rate market.
Yep.
Supply chain issues that we've also had in the past. What's your view about the construction industry overall?
Well, in terms of the construction industry, there have been supply issues, particularly, I guess, through China. If you look at Shanghai, it's a major port in the world, and when it had a COVID lockdown, that did actually stop or slow supply. But what's interesting is that people always look for alternatives. And it might be that if they can't source a product from one country, there's other alternatives which they can source product through. But I go back to what I said earlier about lumber prices and about iron ore prices. And they're such a big component in terms of construction costs. So we're seeing those tempered down, and we're also seeing in terms of Shanghai that those markets are starting to open up as well. So in construction costs, I think that we will see a slowdown in terms of the price increases, but we'll still continue to see some builder failure.
Yeah.
And that's the issue with the builder and developers, of course, is that they're caught between two ends. One is rising construction costs, and of course the other one is in terms of either pre-selling their project at a low rate.
Locking that sale price in.
Yeah, or alternatively not selling at all. So as a result, and of course with declining prices, that has an effect in terms of profitability. So I suspect we'll still continue to see that. In terms of our portfolio, look, we've only been impacted to a small degree by one tiny project in Brisbane.
We're in a rising interest rate market at the moment. What's the impact on our monthly income trust, Phil?
Yeah, sure, Walt. That's a great question. I got to say, where we wrote loans at a lower rate in the monthly income trust previously, those loans are either refinancing or repaying, and as they do so, we're able to negotiate a higher rate with those borrowers or with new borrowers. And the benefit we have with the monthly income trust is that a significant portion of that book is actually repaying quite regularly. So it means that we can take advantage of rates as they rise during the course of the market cycle, as they are at the moment. And that, of course, means that it's a better experience for the investors so that they can take advantage of it.
Now, Phil, we have seen a little bit of disruption in the property market, certainly also construction game. What's some of the risk mitigation steps that we have in place to try and overcome some of those obstacles that we're seeing?
Yeah, sure. We've got to look at what sectors we think will be most affected by that. Now, the obvious one to me is that when you look at a downward cycle, it's usually the holiday house or so, which would be most affected. So normally you'd say, well, look, that could be the Gold Coast. And if you look at previous market cycles, certainly the Gold Coast is one of those markets that really has a big head of steam, and when it's going up, and then when it goes down, it usually has oversupply issues, and you see prices declining. What's interesting at the moment is that these markets don't necessarily have a lot of supply issues, but it is one market that does, that we're focused on at the moment, simply because if households ultimately are under stress, the first thing they'd sell is their holiday home. So that's one. Another one is just looking at affordability. And if you look at affordability, it's probably outer suburbs of Sydney and Melbourne that might be affected, particularly those developments which are aimed towards the first home buyer. Having said that though, it's interesting at the moment is that normally when you see markets become very frothy, and then of course they suffer a downturn, there's usually a lot of oversupply. You know, if you go back to not that many years ago when there was oversupply of inner city apartments, and we know in Brisbane that there were plenty of apartments which were either for sale or for rent, and when they were for rent they were offering Foxtel and 1 month's rent free and everything else like that. It's interesting at the moment because we're not seeing that oversupply issue to any major degree, but the other thing which compounds it is that we're seeing quite a low vacancy rate as well. So it's not like there's an oversupply in terms of rental. There's actually a shortage. If you look at the vacancy rates, you know, in Brisbane, for example, they're less than 1%. So that provides, I think, some underpinning of property market. And of course, we're yet to see residential investors come back in the market. Now they will once rents start rising, and they are rising right at the moment.
That touches on the key points that I really that I wanted for you to discuss. So thank you for that, Phil.
And I might add to that, Walt, is if that's one part. The other part, of course, is looking at what we do to mitigate that risk.
Yes, correct.
You know, we've got a lending committee. We're quite an active lending committee. We've got a lot of different skill sets on our lending committee. I've got my background as a lawyer. We've got David Hogan, who used to be the head of property for Challenger. We've got accountants. We've got also previous people with real estate development. We've got quantity surveyor, and also we've just engaged Ross Perkins, who's previously MD of M3 valuers. So Dorian Valuer in terms of the NDIS, etc. area. So as a result of that, we've got a good cross section of skills, so we can look at these projects when they're put to us, and we meet every week. So we meet to discuss these loans every week, and the portfolio managers put forward a presentation to us, either by exception or by an in-depth analysis, and then we look at how the portfolio is tracking, and we look at also we get quantity surveyor reports on drawdowns every month as well.
You mentioned the lending committee meets weekly.
Yep.
It means that we are proactive in our approach to the loan book.
Yeah.
And our default rate at the moment is sub 2%. Can you just maybe speak about that, if you don't mind?
Yeah, sure. I think if you look at our default rate, it's been typically that sort of level for some years. And
it's a good rate, Phil.
Yeah. But of course, we're dealing with 160 loans at any one time. There's always going to be one or two that will have issues at some point. But I've got to say, by having the skills of the lending committee, we're able to look at that. We've also got some great people as portfolio managers as well. And really everyone is trained. We work collegiately together so that we can identify issues when they occur. We don't want to be like you would see perhaps in a typical lending environment where people only realise there's a problem after the fact. So we like to be as proactive as possible. Now, of course, nothing's guaranteed, and it's a way of just trying to keep an active approach to the loan, so that if ever anything does have issues, we can identify that. It may be, for example, that where there is a builder who is having problems, well, we might appoint a project manager to manage that particular project. It can be that sometimes there's additional equity which has to be injected, and we go to the developer early in the piece to do that. So, look, there's many reasons as to why that is.